The precious metals markets have really been stealing all the attention recently with the gains that we've seen in the gold markets now within $40 of an all-time record high. For more analysis from a technical viewpoint, let's now engage with Ron William from RW Advisory. Ron, it's good to talk to you. It's been a year, I believe, now since we last spoke about gold in any serious developments. And of course, a lot of water has passed under the bridge since then. What are your observations at the moment on where we are with the price of gold?
Well, back then and still now, the golden opportunity remains ahead, arguably any hour and any day now, because we are just so close to the record highs of 1920.
Let's take a look at a chart then to engage with what's been happening, because I think this big gain that we've seen over the last year or so, this takes us back actually to July last year. So this is a one-year chart. Apart from the blip that we saw around about the time of the breaking of the coronavirus and what happened there, that took absolutely everything down. Stocks, bonds, currencies, if you're looking at safe havens or whatever it was. And since then, we've seen this big escalation. Here we are now, as I say, $40 away from the record high. What's your observation of this chart before we get into your deeper analysis?
Well, I mean, originally this wasn't an easy breakout. It was moving sideways for 2 months, and even I was looking for short-term overbought trades until the market then flipped the other way. And so technical analysis experience teaches us that the best patterns are the failed patterns. And so that's what we had, a 2-month short-term failed top pattern, which later flipped from a top to a break up into what we're seeing right now. And most importantly, we were testing the 2011 and 2012 resistance areas just around the 1800 area. Now we've had a strong impulsive move up. And certainly the key target now is the record high at 1920, as you just mentioned there, not far from where we are at the moment. So this is very much market and news breaking stuff.
Okay, well, let's then look into our crystal ball and work out where we go on from there. What are your thoughts in terms of the then future direction for the price of gold? How do you apply analysis that you use to give you an idea as to where the next stop-off point could be?
Well, certainly the trend is our friend. I mean, gold is one of the best performing trends. If you look at it over the last 20 years, there's very few assets that we can compare to this. Add on to the fact that this is a great safe haven play post coronavirus crash in March of this year, 2020. Gold really has a lot going for it. If we look at the chart, we can see that 20-year dynamic regression line, the same one we looked at almost a year ago. But more importantly, here and now, we've got this 6-year base. Again, something we looked at then, but now we're seeing the reality of that base. The bigger the base, the higher in space. That's the old technical analysis teaching. And that implies that we will get not just one, which we've already seen, but 2 times and 3 times, so a tripling of that minimum price objective higher, which would take us clear above the 2000 glass ceiling, and then potentially my upside target is $2,400, which is a confluence of resistance areas. So there's it's the base projection, the regression line, and a harmonic level that I've added there. That all 3 of them chiming in roughly at the same area. And if we look at the actual rate of change, the green indicator at the bottom just shows that we've broken the recent record number of consecutive monthly moves up. So the prior one was 7 months, now we're 8 months, and the record is 10 months. So certainly this acceleration is speeding up and will likely continue. And let's remember the historical rhyme of 1980, where we actually had, as you can see there on the right, a $700 spike in just 1 year. So I don't mean to sound too dramatic, but these things can happen. They have happened, and although history might not repeat exactly the same way, the historical pattern rhyme certainly does give us a precedent to follow.
One of the interesting things about this, and this is something that we've discussed with you before and other analysts, that in fact, if you look outside the US dollar, for example, even sterling, but to other currencies where there's been some more interesting moves, we've seen record highs in local currencies for some months now.
Yes, absolutely. So the rising tide does lift all boats, and certainly gold has been rising, outperforming against other currencies. This isn't just gold and dollar. And although we like to look at gold and dollar just because the dollar has such a strong global base currency effect, the reality is gold has been storming above its record highs in other currencies. So if we look at the G3 currencies, euro, sterling, and yen, but then also add the Swiss franc there as a safe haven play. Also the resource currencies down below, Australia dollar, South Africa rand, and on the demand side, Indian rupee. Gold has just been firing above its record highs and already has done that. That's yesterday's news. Today's news is that there's now a catch-up. Not a new breakout, but a catch-up for the gold in dollar terms. And so we can see all of the chart mosaic there on the right, and on the left it just shows year-to-date performance, where the outperformers are the South Africa rand and the Indian rupee, up 66% and 55%, which is quite amazing, really.
What about the effect of what's happening with monetary policy? I'm thinking most notably with what's going on with the Federal Reserve, because we price gold in dollars. So we've got to be mindful of the fact that the Fed is pumping all this money into the economy. What sort of effect is that having, or is that really the primary effect on the price of gold?
Well, certainly it is. I mean, the previous chart showed the debasement of money. I mean, essentially, that's why gold is outperforming across a basket of world currencies. And so that story, which many people already know, is what we're actually seeing in reality right here, right now. If we look at the move that we've seen in the equity market space, S&P 500 as a case in point, this impressive post-crash rally of 80%, which so many pundits have been talking about, and talking it more up than down. Everyone's saying don't fight the Fed and don't fight the V-shaped recovery. That these seem to be the two ginormous pain trades out there in terms of bullish bias. So my bias remains to be bearish. I expect to peak in a few weeks as we start the month of August. We've already seen intermediate peak in June, which we're now testing in terms of stock market peaks. But this chart really tells the real story. What we see here is, although we saw an impressive 80% recovery since the lows, and everyone's going through the Greek alphabet, V, W, or whatever other shape we can think of, the reality is, if we look at the S&P 500 divided by gold, so the real move, real assets, we can see here that the S&P 500 has only been up by just under 30%. I think it's exactly 29%, so just 1% under 30%. Really a much smaller multiple of what we are seeing in terms of Wall Street valuations. And this is really the internal story. And just the lower chart there shows the primary culprit. Of course, it's been monetary policy. You can see there the Fed balance sheet jumping by 70% in one quarter, just above 7 trillion. And ironically, this might be the time that the Fed starts to unwind a little bit, or at least be more selective. Either way, that might create further fractioning in the market, and more demand and onus for gold buying.
Of course, tied into all this is what's happening with the US dollar, because clearly when you're pricing something in dollars, you've got to look at that currency as well. And if we bring up a chart of the dollar basket, we are very, very close to some relatively near-term support back in March, but you get a break at that. Then potentially you're then all the way on down to the 23rd of September 2018. How do you view this going? Is this a trade that you're following up on as well in conjunction with what's going on in gold? Or is this just really just happening the exact opposite of what we've got in terms of the gold trade?
Wonderful that we can bring up this real-time chart, Jeremy. And to your first point, I do think this is part of the perfect storm, really, which is bullish gold. And essentially, this is the kiss of death in terms of what central bank policy will be doing in the long term. Short term, clearly it's the stimulus that we all need, particularly those that are in need in this post pandemic normalization. But the reality is there are consequences to pay, and the currency itself is now starting to wane. For a whole bunch of different reasons, but certainly confidence being one. And from a technical perspective, we can see the dollar index, which is, Mr. Market really, crowd psychology at its best, actually voting with its feet and saying, you know what, this market's overbought. The confidence is starting to wane, and potentially the central bank policy has overshot. And now we're starting to break below some key levels. So you can see that the first swing low, where you've just drawn the line there, Jeremy, is the crash low on the dollar index. That's what actually created a big 8-figure swing on euro dollar and many other currencies. So it's a real emotional signature in the market. If we break below that, then we're talking about a 2-year breakdown lower. So from 94.80 to around 93 and a bit. If and once we actually break this zone, then we're talking about a multi-year distribution pattern on the dollar. So we'll see if we get that, and certainly it'll be a great talking point later on as we see that the market actually unwind.
The other factor is to consider is all the other effects of this higher price of not just gold but precious metals generally, as those companies that operate within the space. How do you view what's going on with some of the big gold producers?
Yes, well, I mean, the big talk is being Wall Street and the divergence between Wall Street, Main Street, and of course Tech Street in terms of the FANG stocks. But the reality is there's a lot of upside action still yet to come if we look at the gold stocks. And so that was the kind of the last chart pack I brought here to let your viewers know, especially those who are looking for stocks, the investors out there, that if we look at not the FANG stocks, but the BANG stocks, so the Barrick, the Anglo, the Anico, Eagle Mines, Franco-Nevada, and Gold Mines. So this is a newly framed acronym, akin to FANG, but for the gold mining stocks. It shows that there are multi-year base formations that are literally just waiting to pop to the upside. And again, circling back to our initial technical analysis insight, the bigger the base, the higher in space. So certainly this is something to potentially lock and load on in between now and year end, and perhaps in the new year, if this safe haven play and just the general gold story continues higher. The chart on the left shows the BANG outperformance over FANG. So although FANG is up and clearly tech is cool and sexy and has been making a lot of people money, the red line, which is the FANG stock, is still only up 60%, whereas some of the BANG stocks like Goldfields is actually up almost 90%.
Okay, Ron, look, let's wrap it up, and if I can get back to where we were at the start and the price of gold, because I want to ask one final question about this and your experience within technical analysis. As we speak, we remain about $40 away from the record highs in the price of gold. Just staying with this gold chart briefly and asking you the question, technically and historically, when you get a break of a record high, what happens in the market? Do we get there, hesitate, or do we hesitate before we get there? Do we get there and just tip over and wait a while? Or do you then see a break past that and then onto your 2,400 target?
Great question. And I was just teaching this to some trader students. It can be multiple scenarios, and certainly it could be either one of what you mentioned, either one of the options you just mentioned. Now, to be more specific, during an acceleration process, the acceleration continues to some degree, but at some point in time, as I was once taught many years ago, acceleration is unsustainable in the short term. So it's perfectly natural for the market to take a breath, consolidate, maybe correct in a marginal way, and continue higher. So nothing moves in a straight line, even gold, and so we need to be aware of some consolidation or mini corrections as we continue higher. Remember, it's still a very strong 20-year uptrend, where we're seeing this launch off from a 6-year base. Those two key secular or long-term technical structures remain in place. But of course, on the short to medium-term upside move, we are going to see more of a zigzag or a two-step up, one-step down staircase movement. So look for the upside, but do manage your risk and try and trail those stops.
Yep, managing risk is always the message. Ron, it's a pleasure. Thanks indeed for joining us, taking a look at the golden opportunity ahead with Ron William from RW Advisory. If you want to catch up with Ron, do join him on his website.